All right, Irwin, great to see you. Thank you so much for joining me this morning. How are you?
I'm good. A little cold here in New Jersey this morning. It was 21 this morning, but it could have been worse.
Yeah. Yeah, you just got to bundle up. I guess if we want to get started, you want to go ahead and introduce yourself to everybody and
Sure, my pleasure. Irwin Boris, Heritage Capital Group. We're a third generation family office that these days has mostly investments in real estate. We do a few Broadway shows, production here, and some other land development, but money was made in real estate and it's continued to be redeployed in real estate. We have three silos of capital that we use. One is legacy money, which is all family and a few friends that we've continued to exchange over the last 30 years and continue to grow that. We have some institutional partners who put up 80, 90, 95% of the capital on long-term JVs. And then we have a syndication platform where over the years, everybody kept complaining that they weren't invited into the deals, but they weren't institutional. So it started with the country club, and then everyone brought a friend and a relative, and so now we have a syndication platform where we raise anywhere from call it $8 to $15 of third-party equity for a transaction. And over the years, we've been in all the asset classes: retail, office, multifamily, industrial, and we probably got out of the multifamily a little bit earlier than a lot of people. But then we're happy. We're mostly in industrial and logistics and flex because everything performed well during COVID. And I didn't have to eat some of those crazy insurance numbers that the multifamily guys did the last year. We continue to do.
yeah, those costs. It used to be 250 per unit per year for
How
insurance.
about 1,100 or 1,200 if you do the
Yeah,
coast?
you're right, exactly. I've heard upwards of 2 to 3,000 in Florida.
Yeah, that's even Florida. It's like the Wild West. All the carriers just left. We have one legacy asset in Virginia Beach, 448 units. We have 8 ticks in there. It was an exchange for us and some other people. And the insurance went from like 300 a door to 1,100 a door. We've never had a loss.
Yeah,
But it's okay. We have very low debt on it. We keep renovating apartments and banging the rents out. Insurance will get repriced next year and we'll be better off.
yeah. You think that rates are, what I've heard is that insurance costs have gone up because the reinsurers, London essentially, has pulled out. You think that they'll come back and that will reset rates a little bit?
I've heard that the reinsurers had to pay out with all the disasters in the last 2 years. And
Yep.
so some of them have dropped. Some of them are being very selective, but I've already seen potential insurance drop on our Virginia Beach asset closer to 750 a door than 1,100. So we'll wait till the first of the year and we'll go out. I think what a lot of the carriers did is if you were pre-2000 and within 10 miles of a coast in general, you get kicked out of all the plans. Even if you were with a management company that had 50,000 units, they kicked you out.
Yeah.
Some
Wow.
cases. Yeah, no, we'll survive. It's okay. It's all temporary. It comes with the territory. You just have to make sure you have dry powder and you're not screwed down too tight.
Right. Right. I was put my phone on do not disturb.
And that's a pretty good idea. I should do that too, because my kids just call that now, complaining about something.
Yeah. Inevitably, I'll get 10 phone calls when I'm in a meeting. How did you get into real estate? I'm always curious about people's origin stories.
Sure. I guess my father is a real estate attorney, and so I've always had a little bit of exposure to it. I have an undergraduate degree in accounting. I took the CPA exam. I practiced accounting, and the firm had a very large real estate practice, and so I started with a lot of audits on real estate partnerships and condos and co-ops and operating companies. And from there, I went to work for one of the firm's clients, the Lefrak family, who at the time was one of the major multifamily owner-operators, who also did a lot of development. And there I got to see the operations side and the property management side and see what it was like to manage thousands of units, go to landlord-tenant court, try to collect your rent, especially in the city of New York where it's a game, and deal with the union crew and federal and state agencies. And it was interesting. And then from there, I just sort of being owners on the accounting side or being a lender for many years and being back as an owner and back as a lender. And I guess the last really 10 years, it's really been more on the ownership side with a little advisory work mixed in. But I like that it's a tangible investment. It's not binary. It's never worth nothing. It's a
Yeah.
question of really what you do with it.
Yeah. So I've always known you on the ownership side of things. So were you working for a bank or a private
Yeah,
lender or?
I know I worked for a bank. I was working for a developer, and when was this? It's probably 94, going way back. And I didn't like what I saw going on in the office because developers only make money when there's development fees. And I know that if you're not developing, you're carrying the business out of pocket. And so I decided to look for another job, and I saw an ad for a savings bank in New York, and I applied for it. They had me in for an interview, and the woman who runs the department is still there. We're still talking. She asked me what I've been doing and what banks I deal with and how I look at things, and I told her who I dealt with at the time. If you go back through the assemblage of what's now J.P. Morgan Chase, it was called Chemical Bank in the old days, who
Yeah.
then merged with Manufacturers Hanover and then became part of, with Chase. I told her who I dealt with, and she goes, "Oh, I'm having lunch with Laura tomorrow." So after she had lunch, she called me up. She goes, "Oh, we're going to hire you. You're straight. You're honest. You know what you're talking about." And so I was really the only person as a loan originator, a loan officer, that didn't really have the formal credit training, but I knew what a brick felt like to have in my hand. So it was an interesting 5 years there. And they taught me some of the credit training, and they figured my best skill was probably business development. I always smelled the deal worked. I wasn't at the beginning the best at getting the numbers in the boxes, so they helped a lot with that. And we had a
Yeah.
lot of fun.
That's great. That's awesome. Yeah, you definitely learn the mechanics of the business as like a service provider, don't you?
That's correct.
Yeah. So that's how you started. And then how did you transition into the ownership side?
I guess in the 10 years, when I left the savings bank, I went to GMAC, which has now
Yeah.
evolved into Bricadia through changes and things like that. And I had a good exposure to office, multifamily, as well as structured equity, joint venture equity, and a lot of industrial. And when the Heritage guys who I worked with and for, they were one of my borrowers 20 plus years ago. And so we've always had a good relationship. And that's how it just naturally progressed. I've been in and out of here for 20 years with them, depending on what they were doing. We bought thousands of apartments together. We do a lot of industrial. Even in the middle of COVID, we probably did 500 million bucks. We had whole airplanes to ourselves.
Yeah. There's nobody flying in
No, there
2020.
was nobody flying. You get on a plane, you always got the upgrade to first class. With 10 people on the plane, I don't know why they were flying them, but they did, thank God.
Yeah.
The hotel was empty. You had your choice of a rental car. And there was also a lot less competition when you
Right.
looked at properties. I've been between, that's the current gig, and in between that, I've worked for other owners. I put together, I think when we met, I was working for CDR, which became 3 Points Realty Partners, owned by the Israeli firm. I was the chief investment officer. We were buying apartments all over the country. And I have a good exposure to apartments as well as owners, managers, and investors. But I think I really like the boringness. I don't know what to call it. Being boring is good with industrial. It always pays. I don't have the excitement of fires or, God forbid, shootings or people selling drugs in one of my apartments or worse, there were floods. Although in the city yard days, we did have we bought a couple of apartments that were part of I guess, a bankruptcy proceeding that KKR got involved with and bought the portfolio. The guy was a bad dude. And we backed on one of the canals for Buffalo Bayou out in Houston. And the water crested to the top on the canal. We didn't get any flooding, but I know it was pretty bad. They still own that asset, but I don't know what they're going to do with it.
Yeah. Houston's the Wild West, literally. They have
Sure.
no zoning, and seems like seems like over the past, I don't know, 5 years since capital raising became restructured from about the time that they allowed crowdfunding and all that. Seems like everybody and their brother got into it and is a syndicator. And Houston seemed to be a market. Houston and Dallas were markets that it seemed like people just flocked to.
True. Everybody who wanted to be a syndicator became one, except for the last 12 to 15 months. It was really hard to screw up a deal. You had to really work hard at it. All the leaky boats came off the bottom of the ocean.
Right.
And then as interest rate rose and operating costs really started to spike, you couldn't bail them out fast enough and they sank. And so now a lot of my investors ask me for help triaging some of their other investments or helping them post-mortem on some of the stuff that just went totally bad. And they're like, do I throw good money after bad? And I said, let's look at the original investment. And I noticed that as interest rates rose, the underwriting got a lot more aggressive, where you're always growing your income, but there was always some explanation of why your operating expenses were only going to grow 1 or 2%.
Yeah.
And we know that never happened. Payroll really shot up. It's still hard to fill. Management companies are still trying to hire. Insurance really went up. Taxes went up, especially coming out of COVID. Everybody wanted to get reimbursed for all the money they laid out, all the municipalities. Everything costs more. Supply chain issues. So a
Yeah.
lot of those deals just tanked. That, and I think investors got lazy. All the earlier deals worked out. They kept doing one after the other, and everything paid off. So I think they just did a lot less due diligence and asked a lot less questions in the most recent ones as well. And if you really ask them what attracted them to the deals, it's always, I'm looking at that IRR, I'm looking at that multiple. And
Right.
that's why I think it's a trap for a lot of people.
But yeah, you can very easily manipulate the IRR on a deal by either trending your income up aggressively or just having an aggressive exit cap rate as well. When you're underwriting a deal, what are the things that you're looking for, that you're targeting? What are you keying on when you're underwriting a deal?
We one of the key metrics for us is current cash flow. So I'm not buying like an apartment. So you're always upside down on interest rate versus your cap rate. And so even today, I could find enough industrial deals and flex on 9 caps. So even if it cost me 7 to borrow with leverage, I could pretty much pay 8 the first year on most of the deals, sometimes 9. And so we keep buying them. So it's really, who are the tenants? Why do they need to be there? If they move out, how easy is it to fill? And the operating expenses. I look for deals that still have some real pop by converting the last couple of gross leases to triple net or modified grosses to triple net. And we really look for deals that have excess land, which could be an additional development site at some point in the future, or at the very least turned into surface parking and storage. And there's actually a lot of interesting deals out there that can get done on higher cap rates. But just, we were doing this long ago, long enough time, I can't talk anymore, that we know what to look for. And one of the things that we've really realized over the last 4 to 5 years is it's all about the employees that work for those tenants. If you're, like back in June, we closed an 800,000 square foot building in Seymour, Indiana. No one ever heard of it. Or it's outside of Indianapolis, but it's on the main truck road. You can be anywhere within a day by truck. The tenant employs 450 people in 2 shifts. For them to move to another state, they have to figure out where they're going to hire. For them to move to the other side of the state, they have to figure out how they're going to replace employees, because people aren't going to travel an extra 30 or 40 minutes when they get another $1 an hour down the road.
Right. Yeah.
So a lot of our interviewing when we go on site is really talking to the facilities manager at the tenant. How's business? What's the sense of family you have here for your employees? Just we're trying to figure out how sticky they are.
Mhm.
And we've been able to explain that to life insurance companies, where I can get a 7-year loan, but I only have 5 years left on the lease term, because even the insurance company is confident they're going to renew.
Yeah, that's interesting, because that's always been, and honestly, I don't have enough experience in industrial or flex to know what I'm talking about.
Well,
But
think about flex as the multifamily of the industrial world, because you have a lot of small tenants, sometimes a whole bunch of 2 and 5 and 7,000 feet.
okay. But yeah, that vacancy risk seems, whereas the attraction with multifamily, just like you mentioned, is you have a lot of tenants and you can spread that risk around. If you have one 800,000 square foot facility, like that seems like a tough thing to fill. So maybe share with me a little bit about how you get comfortable with that.
Sure. In that particular transaction, we were really comfortable by the fact that there were 450 employees there.
Right.
And it's like a super highway of forklifts. If you don't watch 5 different ways, you're going to get flattened by those forklifts running through there. And they're heavily entrenched. There's a lot of investment in the facility itself. It's a 40-foot tall building. It's racked from floor to ceiling. And I know that for them to move, they'd have to worry about how they're going to replace their work staff. Their existing rent is below the market on some of the newer construction deals that are out there. And you'd have to think that it's easier. Industrial in general is a game of nickels, dimes, and quarters on rent movement. And it's easier to pay over the long haul over the next 10 years, $2 more a square foot or $3 a square foot than it is to try to train 100 new people or 200 new people at another location if you can't get all your employees to make the extra drive. So that's how you get comfortable with some of the things like that. In one of our properties down in Chesapeake, Virginia, I have General Dynamics, who does torpedo tubes and other things for the Navy. They have a lot of heavy equipment and heavy electric. Now they're tied to the Navy that's down there. And so you can't be in the floodplain, which we're not. A lot of the plot properties are in the floodplain, being coastal down there. And so I know they're not going. We also have First Data. Like when you lose they do all the credit cards. When you lose your credit card in the middle of the night, you call American Express, they call First Data, who gets the metal blank out of the vault, codes it, and ships it out Federal Express. Their building is built around the 20,000 square foot vault. And there's a restoration clause in the lease. If they move out, they have to remove the vault and restore the building.
Oh, yeah.
Yeah. So there are things that you really have to read into. And when you look at how long people have been in some of these locations, chances are it's an 80% renewal probability. And if you're in the right market, you can backfill it with somebody else. It's all about, again, not screwing down the model too tight, having dry powder so you can pay for tenant improvements and leasing commissions and potentially still carry the building without having to call capital from your partners with pay the mortgage. And it's about structuring your leases so you have enough notice period. On the larger tenants that have renewal options, they have to let me know 12 months in advance.
That they intend to renew or not.
Yeah, and if they fail to notify me, I have the right to market it, and they agree to cooperate as I tour people through the building. Even on tenants that don't have renewal options, they're at the last option, and it says, if you're within 12 months, I'm going to start to market your property. And as they see me calling to make appointments to tour new tenants through, they wake up and say, oh God, we want to stay.
Yeah. Oh, we need to get our act together, or
we need to get our act together. Either we got to tell the landlord that we're staying, or else they're going to have a new lease signed and we're going to get kicked out. And then on the smaller properties, like also in Norfolk, we have a lot of smaller tenants who might be 3,000 feet, 5,000 feet, 10,000 feet. In Atlanta, I bought a property in the middle of COVID. I bought it from TPG. I have anywhere from 3,000 feet to 40,000 feet. All right, the 40,000 square foot tenant was a trade school that we inherited. We found out in February that they're not renewing their leases. They're closing as of December 31st of this year. We already have a third of it leased on a really stupid rent because it's a shorter term lease. And I have one of the tenants next door who wants to expand. And then I'll be left with a small space. So it's about giving yourself enough runway. It's not like in multifamily where you send out the renewal 90 days in advance and you know, and even then sometimes tenants don't exercise until the 11th hour or tell you they're leaving. But there, because there's so many apartments, assuming it's a larger complex, so you're okay for 90, 120 days till you find another.
You mentioned something earlier about finding deals with, and it translated in my mind of value add opportunities in industrial. And you said it was finding ones where you're switching the gross to triple nets or modified grosses to triple nets. Can you talk a little bit more about that strategy?
Sure. Normally in multifamily, the landlord, you may be able to get reimbursed for water and sewer through RUBS, or maybe you have separate meters in the apartments. Electric is pretty much all separate meter, except some of the really old stuff. And then even then the landlord's passing through some of that in some form. in some of the commercial buildings, office too, but they're on gross leases, which means the tenant pays a fixed rent. And if the landlord's insurance and utilities and taxes go really up, the tenant's not responsible. So over time, because in general, the market has gone to triple net, where the tenant pays a pro rata operating expense of taxes, insurance, including the management fee to the landlord. We try to look for the buildings that are mom and pops where they haven't done all that. And there are a lot of them out there. And but then it's also a process of educating the tenants. For example, if they're paying $15 a foot and you have $3 of operating expense, don't expect them to pay 15 plus the 3. You're gonna have to ratchet down the base rent a little bit. On the renewal or on the new lease, you're still getting an increase, but they understand that you're reducing the rent, but they're sharing in the operating expenses. And it's worked really well. And we like it.
Yeah, does that tend to round out to generally a net positive for you? If it was 15 plus $3 triple net, that'd be 18 as like a gross rate.
No, but they may have been on an old lease that was 15 gross.
Okay.
And then I'm eating the $3 a foot in operating expenses, where I can say to them, look, your lease is up and the new rent on a gross lease, we're not doing gross leases anymore. We're going to raise your rent X%. So they might be, instead of being on 12, they might be on 13.50 plus the $3 of operating expenses. I'm still getting an increase, but I know pro rata, if the taxes went crazy or if my insurance spiked, then I'm not going to eat it 100%.
That's a pass through. Yeah.
It's a pass through. And we've been pretty successful at that. Even now, I'm looking at several transactions that are still like that, where some of the tenants are on triple net. Some of them have modified gross, which means they're only reimbursing over a base year, but they've been there for a long time. And I pray that the leases expire early. Some people, if you think of the institutional buyers and some of the REITs, they like long-term triple net leases. I like short-term leases, what they call WALT, weighted average lease term, because it gives me more of an opportunity to move the tenants and the rents around. So that's the other thing we look for. We look at that as an opportunity, not as a con to the deal.
And is there a reason that you prefer industrial and flex over, say, retail, strip centers, and maybe multi-tenant office buildings?
I guess we've owned multi-tenant office. That's how I met the guys here. I was their banker. We used to give them money on vacant office buildings. And I've seen that when you lose a major tenant, you're screwed. Even if you have a year's notice, depending where they are now. Look at all the empty office buildings around the country that the banks are taking back. I think that some of that is due to mergers. Some of it's due to this remote work. I think that buildings that are largely full now with longer term leases, when and employers permit some kind of hybrid working environment, you don't need a desk for everybody. So they might scale back a little bit.
Yeah.
And as everybody looks for profits, I think they realize that not everybody needs a high-priced office building in the CBD for 100% of the employees, when you could probably find something out in a more suburban location for half or less on a per square foot basis for rent. Office we've done, it's not something, I'm glad I don't have any exposure to office. Retail I've done, but again, we see retail coming and going all the time, depending on what the business is. A lot of people still shop online. I know that there are very few stores that I physically go into when I know I can buy the stuff online. Especially if it's free shipping and free returns, it's just so much easier than to deal with brick and mortar, deal with traffic. Like driving around near my home yesterday, just trying to get somewhere and looking at the traffic. All right, it's holiday, it was 5 o'clock plus the holiday shopping traffic. It was a disaster. When a lot of these places have same day delivery, next day delivery, curbside pickup where you can order it over the phone and just pull up and they bring it out to your car, and it's a matter of convenience. All right, some of the higher end stores are still good. You still have to go in, whether it's Gucci, Fendi, Armani, some of that stuff you're going to want to really try on with a salesperson. I understand that. But that's by and large not the majority of the retail. Would I own a grocery anchored retail center? Yeah, with the right grocer in it. That I don't have a problem with, because as long as the grocer is good, and that's like giveaway space, because you need them there, that fills up everybody else. So I have looked in the last couple of years at grocery anchored retail. But for one, there's always someone who wants to pay more. You got to bid with your head, not above it.
Yeah. When I was first getting into real estate and I was interviewing with different companies, they're like, don't say that you want to be in real estate because you like the buildings. But there is that tangible aspect of it. And you did mention that at the front, but you're also right that you can't fall in love with the real estate. It may be a pretty property, but that can't be the reason to buy it, because if that's how you're buying, you're gonna be on a road to disaster.
No, it's true, but we do look at every investment as if we're going to own it forever. So as long as I'm willing to own it forever, it's fine. At the end of 5 years, actually every year we test the market and see what we might think it's worth. And if it's a crazy enough number, we talk to the investors, even though I don't have to. We say, what do you want to do? And when you're there 3 or 4 years into a deal and it's generating 12, 13% current, and investors are like, we like the cash flow. What else do you have to exchange the money into that'll produce that kind of cash flow? And or even if it's a deal you've had 4 or 5 years, and maybe you've refinanced it once, and the investors have relatively little or no equity left in the deal, and it's still generating 10%. Why would any investor choose to sell it? It's like a bond
Yeah,
with tax benefits. So it sounds like you're married to it. It's an investment, and I'm never going to look for the shiny new toy to put on the corporate brochure, because those just don't make any money.
that's true. So when you're looking at an investment, you underwrite it as though you're going to hold it forever, and you
Yeah, it's
don't
a
have
long, as if it's a long-term investment. What do we think, the pros and cons are? What does the physical asset look like? Do we think when year 7, the building's going to fall down? Do we think in 15 years it's going to be a problem? Even if we go to sell it in 5, 7, or 10 years, what kind of deferred maintenance do we think there's going to be that might affect the sales process?
hmm
It's maybe some of those things you would address over time. We're fortunate that one of the partners on the management platform, because we do manage our own assets, is an engineer. And actually, it's funny, he met the principals when I met the principals on the same building that I financed. He actually was the operating engineer for the office building.
Wow.
And we get up there, we look at the roofs, we look at the electrical capacity, we look at the plumbing, we look at it all during due diligence. I know the lender always orders a report. They don't really look at stuff. It's just a file filler when the
hmm
lender does it, unless there's something blatantly obvious that they find. But so we like to look at the building and see, how do we think it's constructed? Do we think it's going to be around for a while?
Yeah.
That also helps in determining how long you want to own an asset.
Elimination of potential functional obsolescence,
Correct.
you might say. Yeah. What are some of the biggest lessons you've learned in commercial real estate during your career?
You never get married. You're never married to an investment. You have to learn that you can't always, money doesn't always fix it. And sometimes it's better to sell it at your basis, or even a small loss if things happen over time. I've also learned that someone else, don't think that everything's a done deal. There's always someone that's going to pay more for it. And don't overbid, because you really need to make your money on the buy. That's really what sets you up for success or failure, by buying it right or overpaying. I also learned that you shouldn't over leverage. And especially if the economy is going down and your building is losing occupancy and you have mezzanine debt or preferred equity on there, mezzanine debt in a down market cuts you twice. It just does. And so we've learned we don't look for a lot of leverage. It's maximum of 65%. Amortization is not a bad thing. It's your friend.
Right.
And a lot of people are like, no, I like the interest only. I'm like, but there's a speed bump in the economy and you have maturing debt you need to refinance, and you haven't amortized, and you might have to write a check.
On the mezz debt piece, would you say the reason you said it cuts you twice is because you have the high interest, so to speak, that they charge, and it's also a recorded lien, so they could take it back from you too?
Potentially, they could cram down your equity, almost like preferred equity, depending if it's recorded or not. It's a pledge of equity, the mezzanine. Or they could take it back from you, and it hinders your ability to maneuver sometimes or refinance if you can't pay it off, depending where the value is. So I would say to people, don't stretch for the last nickel like some of these crazy bridge loans on multifamily people were doing. That's how they made them work, is through the leverage. And I think some people learn some valuable lessons. We always take full-term interest rate caps on the floating rate deals that we have done. And people laughed at us 4 years ago. We did a bunch of floating rate loans, and when everybody first converted to SOFR from LIBOR, and SOFR, I don't know, was 30 or 50 basis points. It was nothing. And I think we were like 150 over SOFR. And we bought 7-year interest rate caps. We're laughing now because the caps are all paying. And everyone's, how did you know to do that? I said, we just like to sleep at night. That's why I have no hair. I lost all my hair.
You didn't buy some caps, and then that's what happened.
That's right. No, but we're just very conservative. That's why I say, Jeff Greenberg, the principal, will tell you we're the boring company. We don't take risks. We like to collect rent. We like to pay distributions. We don't like surprises.
So how does why not just take a fixed rate loan instead of buying rate caps?
Because sometimes the difference between the fixed rate and the going in floating rate are dramatically different. I think back then it was talking like 2% to start versus a 3.5% fixed rate. And we were looking at the forward yield curve, how fast was SOFR going to move? And we bought a SOFR was 50. I bought a 200 basis point SOFR cap. So when SOFR hit 2, it was 50. It would take a while. It was still, with the long term, I think the fixed rate is slightly lower, but we got so much more cash flow at the beginning while we were maneuvering with the value add and doing some lease up and changing some tenants that really paid.
That's interesting.
And also with a floating rate loan, I don't have a prepayment penalty.
Right.
With a fixed rate loan, you're stuck. Okay, at a 3.5%, given where rates are now, I can get out of without a prepayment penalty, but you don't know where that was. We have an institutional partner who wanted flexibility on an exit. And now every year we say, look, we got this crazy offer. They're like, no, we like the cash flow. We're not selling. I'm like, we're fine. It's okay.
Yeah. Interesting. So I guess if you do a floating rate with a rate cap for full term, that essentially amounts to a fixed rate, but you do get higher cash flow up front, and then you don't have the prepayment penalty. So it's just a different way to engineer the deal.
No, it is. And even today, if we were to sell the deals, I still have term in those interest rate caps. They have a value. So you own the interest rate cap. That's an asset.
Yeah.
Depending on what you want to do with it.
Yeah. So speaking of interest rate caps and all that, what are your thoughts on the current market and then what the Fed is signaling to be doing in 2024?
I think that they're still telling you they're going to watch the data. I think that we probably will see 1 or 2 rate cuts. Some people, you read the same crap I do. Some people are predicting 6. I think, yeah, I've heard 6, I've heard 3, I've heard 4. I think you see probably at least 2. And I think if they don't happen by August, because it's an election year, they're not going to, the rest won't happen until 25. I think if all of a sudden the data were to go negative, really negative, they would cut faster, bigger cuts. Instead of 25 basis points, you might see 50 and a 50. But they're also trying to make sure there is no, as Alan Greenspan would say, irrational exuberance in the markets. I know it's impacted the single family market with home buyers, and people that might think of selling aren't selling because if they have to buy another home, what it would cost to finance. Like, I know I'm paying 2.75 on my house. Not that I'm looking to sell. My kids are finishing high school or in college, and so I'm not selling for quite some time. But there are people that the market keeps perceiving would definitely sell. But then if you go back to Rich Dad Poor Dad, Robert Kiyosaki, who says, your house is not an asset. Stop thinking of it as such. It's a liability. Anything that doesn't generate income is a liability. And it took me a while to think about that. And I'm like, he's right. I probably could have rented almost a similar size house for half of what my carry is. And I could have taken the rest of that money, especially since they eliminated the SALT tax deduction. I probably could have taken that money and invested it elsewhere.
Yeah. 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 It's unfortunate. And that is a lot of people's, what they think of as their largest asset, but it is, you have to service it every month. So,
No, you have to service it. You got to fix it. You got landscaping.
yeah.
It's not the mortgage that you have to pay. It's the upkeep, which sometimes is just as much as the mortgage payment or more.
Hmm. Yeah. And if you're not budgeting accordingly, you'll get a big expense and you're like, man, I wish I had a different outcome right
And
now.
you're also stuck if you rent every year when the lease is up. You can move somewhere,
Yeah.
another town, another city, another state, whatever you want to do. With a house, if you have to sell your home and you're being relocated, you're subject to the market.
I think you may have seen the same graph, but I saw one that showed that renting is actually for the first time s- significantly less expensive than owning a home because of
Yes.
the interest rate increases. I think that happened over this past year.
No, that's true. And that's why you have all these investors doing these built to rent communities because people want to rent and it's actually worked out well for them because of that.
Yeah. What do you think about BlackRock and State Street and Vanguard trying to buy up all the single family homes?
Yeah, I don't necessarily think it's the worst thing in the world. I think that at least when they're institutionally owned, they should be maintained properly. God forbid something happens, you got someone you're going to sue, that can pay. But then I think that they create more competition and really drive up prices for people that want to potentially buy a home and own it in
Yeah,
some markets.
it feels a little bit scary to me. I can't exactly say why, but I don't know. But we deal in the rental business, so maybe I just need him as a client.
No, maybe you need them as a client. I can understand that. I was looking at a subdivision with someone where we were going to build 100 homes. And I said to them, this is when it was all the craze. I'm like, maybe we should just build them and rent them and cash flow them.
Yeah.
I said, and if we could change the zoning, I'd build them all as townhomes. But I would do it on a condo plat. So if I ever wanted to convert them and sell them individually later, they're like, well, that's a great idea. But now the construction costs are just so prohibitive that I think modular in some markets really makes sense, only because of the time to build. I don't think you really save that much in the construction costs because of the materials, but you definitely get it completed a lot faster.
Yeah, why do you think construction costs have gone up so significantly? Because if you look at just houses from 50 years ago, or um, you needed a modest salary to buy a brand new home, and now I think the average home price in the United States is like 400 or 450,000. Like, why have costs gone up so much?
I think some of it's labor, some of it's lumber. During COVID, what did lumber go up to? The lumber prices were crazy. Steel prices were crazy for a while, but still, people want to get paid. I think people are making a good profit in some markets. Some they're making a lot of money on these homes, and some they're not so much. Land
Mhm.
costs have come up in a lot of markets. Before the dirt was usually cheap. And now when you think of a lot of municipalities don't want more homes, they don't want school system issues, they don't want overcrowding. So they
Yeah.
fight for a period of time. But then I saw something, I don't know whether it was on TikTok or Instagram or somewhere, I guess you could buy a house from Walmart or it was at Home Depot, these little like 2,000 square foot homes.
Home Depot. Yeah.
These folding homes they ship over in a container from China, where you just pull up the top and all the walls pop up and
Not a bad way. I've got a friend who's been exploring modular. He's got some homes in West Virginia at Snowshoe, West Virginia, and he's been building like these ski chalets that are
right.
modular. They come from a factory in, I think, Montreal. And
That's a
he
long
wants
way to ship.
it is, yeah, but he likes the quality and he likes the manufacturer. Those things work, but he is exploring bringing that same model here to the Midwest in Cincinnati and Northern Kentucky. So I'm hopeful to see some of that. Because you're right, you're probably net even on construction costs, but it is the kind of you put a foundation in, and then a week later, you can have maybe not a week, but within a month, you can have a fully finished product.
Correct.
Whereas I'm about to do a 6 unit renovation deal, and I'm figuring it's going to be at least 6 months just to get everything done.
It also depends on your contract and how many other jobs they're working on at the same time.
Right. Yeah.
But you only get one day a week.
I intend to be the squeaky wheel. So
No, I'm sure you will, because we're in this business. We've seen what can go wrong, and even on home renovations. Some of my neighbors, I like the guy who'll be there one day for an hour or two, and then they'll call me. The guy there, they working today? I'm like, no. What do you mean they're not working?
yeah, yeah. It's tough to find good help, isn't it?
No, it is. It is. It's tough to find good help. It's help you can trust. It's not going to price gouge, and that goes in everything from having your car fixed to having home repairs done. It's universal, especially now. People want to get paid more, I find.
Yeah, inflation, just like we talked about it.
No,
Everything's
I
gone up.
understand that.
So you mentioned that you're mostly out of multifamily. You still have
Correct.
some assets in Columbus. Are you interested in selling them?
No, actually, we have some. They're long-term holds, and actually, the only one is actually to Virginia Beach, and I have a couple in Manhattan rental buildings, and there's really no equity in them, so there's really no point in selling them because I have to figure out how I'm going to replace the cash flow.
Yeah.
But given where cap rates are and interest rates are, that we are looking again, and I probably will, after an absence of many years, make it out to San Diego this year just to
Okay.
see what the
Nice.
buzz is in the
Yeah.
apartment world. I do some consulting for a fund in Manhattan, a hedge fund that has a very large interest in a modular factory in the Midwest, upper Midwest.
Okay.
And so I will look for development sites in whether it's Wyoming, Colorado, Montana, Idaho, up in that neck of the wood, because I know that I have a JV equity partner.
Hmm.
And I'll get priority at the modular factory.
Yeah.
And they build a pretty good product. Actually, I didn't realize it that Jeff Greenberg, my partner and principal here, he lives out in Bozeman, Montana. He left Manhattan 5 years ago. And I said to him, go drive this building. It's right by the Big Sky, by the ski mountain there. He goes, that's modular? I'm like, yeah. I'm like, Gurdon built that thing. It's actually, I call it a man camp, but it's employee housing, because when you have people for the ski mountain, there's no place for them to live. So they built dormitory style, private rooms, community kitchens and living rooms, and they build a good product. And I'm looking at the construction costs, and I'm like, that's really a way, as you said, you're going to save the time. If I get the foundation done, I just have to have the stuff stacked. I can go maybe 3 or 4 stories with sticks. And then I just have to get the local guy to slap the roof on it and wrap it on the
Right.
outside.
Yeah.
And I'm done. So we'll be looking for potentially some development stuff up there where we can take advantage of modular, only because of the speed. It's all about speed.
Yeah.
Velocity of the money is what they teach us.
Yeah. You should talk to our Denver land team. They have a lot of sites out there, so they'd be a good one for you to talk to.
Sure.
Let's see. You're looking for development sites. I see we talked about industrial, logistics, and flex. If people want to get in touch with you, what's the best way to find you?
You can put my name to the search bar on Google, you'll find me. I speak at a lot of conferences. Our website is there. You'll be able to find me, email, LinkedIn, my cell phone's there. So people can, I get phone calls out of the blue, and I know where they're getting my cell phone from. It's okay. Just, if you have a question, ask a question. I find that a lot of times any potential relationship starts with question and answer period. People want advice, or they want some help, or they have a deal they can't figure out how to capitalize, or even if it makes sense to pursue. And sometimes people call me, they say, hey, I saw you speak about this. We don't have an exposure to industrial, but I like the way you analyze a deal. It's all about the cash flow. We're tired of betting on IRR. And I've been getting a lot of that in the last couple of months. And as I said earlier, even today, I could find more than enough 9 caps out there. So I'm trying to tie them up because I know the cost of the financing is coming down every day with the treasury rates. And it's about tying them up and aggregating. Years ago, we aggregated 2.5 million square feet, 9 cities and 3 states. And because of the size, it was a 2.5 million square foot portfolio, we were able to get tremendous cap rate compression when we sold it. So
yeah,
it's about trying to buy enough where I could tell the next buyer how I've connected the dots. Like I'm in Indiana, I'm in Indiana, Ohio, Kentucky type of thing there. All the states are there, or maybe in Western Pennsylvania, and or they're close enough together, or they're all in Virginia and Maryland type of thing. So you try to put together portfolios where you can take advantage of your operating platform. You don't want to be the lone flag out in the middle of nowhere where you have to worry about how you get to manage it.
Are there third-party management companies for industrial and flex buildings?
No, there
I
are
guess.
lots of them. In
Yeah.
some markets where we don't have a lot of assets yet, we will use somebody to do facilities management
Hmm.
until we have enough assets that we'll take it all in-house. We still do all the accounting for it, but we have people that we can rely on if something needs to get done quick. But there are a lot of management companies. Some of them are in all asset classes. They do retail, they do a little bit of everything. They just do third-party management.
That makes sense.
But it also depends on the complexity of the industrial. If you have, like I did a deal that closed in August. It's a single tenant sale leaseback out north of Atlanta, right on the highway. The tenant had been in there for 50 years and just didn't want to own the building anymore. So they leased it for 15 plus years. I made them responsible for the roof and the structure itself. So all I have to do, well, they just pay rent every month. I don't care what happens to the building.
Yeah, that's great.
They've been managing it all along. Why change?
Yeah, exactly. And they know where all the skeletons are
Correct.
hidden. So if they're willing to take that risk, that seems like a good deal.
So we do some third-party management also for others that are within our footprint that don't have management capabilities but don't know who to call. People that know who we are.
Yeah, friendly relationship. And
Yeah,
it's like,
friendly
we have
relationships.
something down the street, might as well.
Correct.
What are your thoughts on brokers, and what have you seen the most successful brokers do, and then what are the kind of worst things brokers can do?
Brokers are necessary in the business because they are a lot more connected than you are, at least on a daily basis. They have a lot more exposure to deals, to owners, even to other sellers, or even your competitor. And they could give you a read of what's going on in the market, not necessarily from what is available for sale, but what other people are thinking or what other people might want to do. And it helps you keep your creativity sharp. I find that the better brokers out there do have some limited marketed deals where the seller might not want a full-blown skywriting in the airplanes up there and telling the deals for sale. Or else good brokers might also, some time to time, will say, hey, we're going to take this to market. Take a look before the book is out. Let me know if you want to try to preempt it.
Yeah.
So it's about having a good relationship. It's also about demonstrating that you can close, that you're not wasting people's time, that you don't retrade for sport, as some people are known to do.
That's a good way to put it. Retrade for sport, because it does feel like some people that is their MO. They just want to win at all costs, and it's got to be a mutually beneficial thing for everybody.
Yeah, if I find something during due diligence, it's a legitimate thing, we'll have a discussion about it. But then I also expect that if the seller knows some of these items, someone should say something.
Yeah.
Sometimes we find things like we had a portfolio down in Alabama for sale that we were trying to buy from a longtime owner, and we found out there was an environmental issue. It doesn't really bother us. We've done a lot of environmentally challenged deals. We take environmental insurance, and we understand it, and we've decommissioned old ammonia refrigeration plants. But the one thing I can't take risk with is vapor. That's the new term, vapor. When you have vapor intrusion of some plume below the building, I said to the guy, look, this building, because of the recovery and exhaust system that has to get put in, it really whacks your building, the value in half. The biggest diminution in value comes from potential lawsuits from people that had worked in the building for the last 15 years. It's not looking forward after I fix the air quality of the building. It's people who might come to me and say, hey, I got forbid cancer or some illness, and here's what it was from. I worked here. So the guy didn't understand it. And said, look, people have been in there for 30 years. No one's ever complained. We passed. It wasn't something I could even negotiate a reduction in price for at some point. But no, don't retrade for sport. Be upfront. Be transparent. Don't waste people's time, because it's about having good working relationships and earning respect. It goes both ways between owners, buyers, sellers, brokers. And that's really what's going to bring you the deal flow.
Yeah. Yeah, no, that's fair. Okay. That's awesome, man. We're just shy of an hour. Is there anything else you want to cover?
No, I just think that any potential investor needs to be eyes wide open, ask the right questions. If you ever are looking at investing with someone and they're not willing to provide access to all the due diligence material, especially a live Excel model, I've had people say to me, "What do you need that for?" And actually, a very large public figure that's always on the internet marketing, is people said, "What do you need that for?" I said, "I want to see your assumptions." "What assumptions?" He goes, "Look, we're buying this deal. We're taking the occupancy from 88 to 92. We're going to move rent 20% over 3 years. And then we're going to cash out and everyone's going to make money." I'm like, "How are you getting there?" I won't mention the guy's name, but they're buying 3 buildings in Texas from Alliance Residential. And if Alliance Residential is struggling at 88%, don't tell me you're buying it and getting from 88 to 92 while moving the rents 20% all over 3 years.
Mm-hmm. Yeah, that's suspicious.
It was very suspicious. I don't know if they ever closed on the deals or not. I know that in some markets, rents are flat. When you look at like Arizona, where they have 50,000 units coming online in the next 2 years, rent growth is stalling in a lot of markets. Just if you're investing, ask the right questions, do your own due diligence. And most of all, I would place more reliance on contractual cash flow that can be distributed at closing than betting on nothing for a couple of years and then seeing a big pop on IRR.
Mm-hmm. Speaking of Arizona, I was talking to some developers who are active in that market as well as ours. And they're like, we're starting to see either cash in refis
Yep.
or motivated sellers because they don't have the cash to be able to do the refi. And that's mostly on new construction. And what they're telling me is that the agencies are like forward pricing, so to speak, that market because there is so much product coming on and they're not forecasting as much rent growth. In fact, they maybe even have flat or negative rent growth. So I thought that was interesting.
No, that's it. But also, you got to be careful. Don't overextend yourself and
Yeah.
figure will I need, could I need this money? God forbid there's an emergency, because once it's in a deal, you can't get it back.
No, you can't unless you want to sell it at a massive discount. So
Yeah, that's what I'm saying. Then you can, yeah, but then you shouldn't have to do that. So I just think that some people have learned their lesson the hard way. Others have not. And I think that
have not
cash
yet.
flow, not yet. Cash flow real estate is a great way to create wealth as well as an income stream long term. And over time, if you keep doing it, you could create potentially generational wealth. If you think about some of the big real estate families and how they continue to grow their net worth, but you have to do it conservatively and you have to be eyes wide open
Mm-hmm.
on what you choose.
Yeah, slow and steady wins the race.
That's right.
Awesome. Irwin, thank you so much, my friend. And I'll look forward to seeing you in San Diego.
No, I'm looking forward to it. I haven't been out there in a while, and I don't even know who the players are anymore. But I'm sure it'll be a good time. I wasn't going to register for the conference. I'll make up a name tag. I'm just going to go. I'm not planning on going for the sessions or the meals. I'm just going to really see what's going on out there and see what the multifamily buzz is. But then again, we buy for cash flow. I'm not buying on a 5 cap or a 6 cap if that's what it costs to invest. Actually, I saw some podcasts from, who was it this morning? Iris Zlotowicz, who founded Eastern Union, one of the brokerage firms. And he said, ideally, he says your going in cap rate should be at least 200 basis points north of your financing rate.
Right.
And I'm like, yeah, go tell that to everybody who bought a value add deal.
Right. It used to be that way, but not
It was more
anymore.
like 300 basis points under the financing rate.
Yeah. And then they're going to bump rents and
Yeah.
Yeah.
So I just thought that was entertaining. I saw that early this morning.
Yeah. Yeah. All right. Well, thank you so much. And I hope you have a great day.
Thank you very much for your time, Dennis. Bye-bye.
All right.